Welcome to Cambridge House Live. I'm Bridget Anderson at the World Resource Investment Conference, and I'm joined by Danielle Park, President and Portfolio Manager for Venable Investment Council. Nice to see you again.
Thank you, Bridget.
I want to pick up with some comments that you made recently regarding the S&P and the Dow. You said the underpinnings of the rally have been so sketchy that it's laughable. So what makes this rally then so unstable?
Well, in the one hand, you have the slow global growth story, which has been, accentuating since 2012, and we're seeing recessions in most of the OECD countries. More than 70% of them are already in contracting mode. So as the slow growth theme has swept across the world economy, at the same time you have companies with record levels of cash, which are fueled by the easy credit policies that we've seen out of the central banks. So companies come to this slow growth environment, look around and say, not a lot of great investment opportunities here. I know, let's buy back our own shares. And so you see this recycling of this really free cash that the major corporations have been able to receive and that are holding back into their own company shares, which boosts their own share, boosts their earnings in the face of falling revenues. So you have this incredible disconnect between the world economy and the stock market, or at least the major stock markets of the world, which are supposed to be a leading indicator for this growth cycle, but in fact are off in this sort of world of its own.
So how do you then not follow that herd mentality?
Because, the thing is that the world is awash in a massive speculative episode at the moment. And every time in history that has happened, it has ended the same way. And that's in tears. So you see that you have to look at what's propelling the price. You have two choices. One, you can say, I'm going to participate and I'm going to hope that I'm able to sell or hedge my downside when the flow finally reverses. Or you say, this is crazy and nobody knows how long this can continue, but when it does reverse, it'll probably do so in an incredibly abrupt way. So, for example, last week we saw the Japanese market, which has been on this insane tear in the last 6 months, fall 7% in 1 week, and people are sort of taken back by that. Actually, we're in the kind of environment where you could see, a crash like '87 where things drop 20% plus in a given day. It is that unstable right now. And so, you have to be mindful of that if you're choosing to participate.
So then, if you can't really tell what's going on by watching, the Dow, or then what market indicators do you look for?
Well, the things that I think are most pivotal right now is the margin use, as an example. You see, investment markets basically have a certain cohort of investors that are always in them. Pension funds, long always mutual funds, asset managers that have a mandate to be fully invested in equities. They're basically always in these markets. The people that drive the obscene cycles at either end are the levered participants. So you really need to pay attention to what they're doing. So for example, we just learned this week that leverage use, margin use in portfolio accounts at brokerages is at the highest level ever in history. So we had an incredible peak in 2000 with the tech bubble when everyone was very bullish and over speculating on borrowed money. You had another peak in 2007 when everybody was sure that China and the commodities run would never end. And now you have us right back above that peak. So that tells me that, and why that matters is, yes, there's those long always investors that are always going to be there, but those margined players are the ones who sell once price starts to weaken. They're forced to sell, and they present this cascade of falling prices, which hurts everybody, not just the margin players. It hurts those who are there trying to be, quote, long-term investors as well.
So what are you telling your investors then? How do you find the buying opportunities in this market?
Well, I was looking back to, for example, I was here in January and people were sort of saying, are you bullish yet? Well, on the junior resource sector, we've actually achieved the downside test that we thought we would get.
You think that we've seen the bottom?
Well, we are in a bottoming process. What I will say is that our target to the downside was the beginning of the secular boom, which started in 2000. So the venture exchange is an example. Long-term secular support was around 700 to 800. We're at 900 today. And that was our downside expectation, knowing that the delevering cycle had started from the peak in '08 when the credit bubble burst, that there was massive overinvestment in commodities and that type of investment. So what you now have is a lot of overcapacity and, as I said, falling world demand. So the venture exchange has tested that low, as if that secular boom never happened. So if you ask me where the price risk is today, I'll tell you there's a lot less price risk in that particular sector. Now the issue is, how long will it be there building a base?
And that is the big question.
And historically, it's taken 2 or 3 or 4 years before you'll start to see breakout to the upside. And that would make sense to me in this environment. In 2009, we saw a great resurgence very quickly. And everyone thought, great, that means the boom is still alive. No, actually, I think that was speculating on the Federal Reserve's interventions and whether or not they would create inflation. And I think that the jury is in now. There has not been inflation created by all this free money because it has not moved through the real economy and consumers have not gone back to spending in their old habits.
So given you're talking about a 2 to 4 year timeline, are there buying opportunities now?
Well, I think that for people who have a longer term horizon, they can definitely pick up some of the stronger franchises today at prices that are a fraction of what they were at the 08 and then 11 peak. The key theme in the world today, though, is income. Everybody wants income. So the other thing that the mining sector has against it really is that it's not an income play per se. So, the other problem is that investments that are income plays today are probably the most overvalued of any asset market in the world because of the low rates that have driven people into them. So if you're looking at price risk, I think that things like the Canadian financials, dividend paying stuff, REITs, has the greatest price risk at this point in the cycle. As I say, once the levered selling begins, it will wash across all those categories, and those people who are huddled in there thinking that they're in defensive instruments will see that leverage takes the good, the bad, and the ugly down. So I think that the greatest risk is in that segment. The least risk is in the resource and mining sector, with the caveat that there still may be a lot of junior players who don't make it to see the next big boom cycle. That would be typical in history, that this washout period takes away the weak players. You see a lot of consolidation, and those who have the cash and stability are able to pick things up at good prices.
And some are saying that we haven't seen the end of that consolidation or washing out or cleansing, or however you want to look at it. Would you agree with that?
Well, the other thing that I think will impact this trend is the fact of, as I'm describing about the fact that in S&P, the TSX is still overvalued. It's being propped up by the dividend paying issues like the REITs and the financials. So once those things start to go, I think it could bring a risk off phase that sees selling across the board again. That said, again, less price risk in the stuff that's already reclaimed its 2000 and 2009 low than the things that are off the stratosphere, back above the sort of all-time highs.
I want to get your thoughts on the housing market, because that's something that you and I often talk about. And we have seen some recovery in the U.S. market. There's no question about that. But what do you think is the state of the housing market in Canada?
So the U.S. market has had a rebound for many of the same reasons that the stock market did. Free, really cheap interest rates, really low mortgage rates, but also just people that had cash that were able to go in and buy these things as an investment. The main theme driving the price gains in the U.S. has been investment. People who had extra cash saying, hey, these prices are down 30, 40, 50, 60% from where they were, and cash is making nothing in the bank. I might as well buy some of these and have some rental properties and that sort of thing. So that's been a force at play in the real estate market in the U.S. In Canada, we haven't seen that yet. Now, I know in places like Vancouver that prices are off about 12% over the last year.
So they're almost affordable. I'm kidding.
That would be a start in the right direction. If it weren't for the fact that Canadian markets were some of the most overvalued in the world, we share that privilege with Australia, who is also in a very similar downturn at the moment. Again, commodities-led downturn. Our currencies, the Canadian dollar and the Aussie dollar, are both in a pretty significant retrenchment mode. I think that'll continue for a while, as will our housing market, which means that we'll probably have quite a bit of domestic weakness in the Canadian economy, which brings me back to concern about things like Canadian REITs and financial shares, which are, as I say, at these all-time highs, just as we're kind of continuing into this slow period. So I think that people should buy a home to live in because they want a home to live in, not because they think it's an investment per se. If you have a 10-year window, your home price may indeed be worth roughly what it is today 10 years from now. If you're looking on any kind of a shorter window, I think you should be very careful here, because a correction of 20% would just be kind of normal stuff in the environment that we're seeing and in the long extended upcycle we've had in Canadian real estate. So for boomers, for example, that are all overhoused today, they have most of their wealth in their home, they're hoping to downsize sometime in the next 2, 3, 4, 5 years. I think those are the cohort of people who should be trying to think about that sooner than later. Because if you look at the young generation that's behind the boomers, they're not well funded, Bridget. You know, they haven't got great jobs. They're mostly living with parents. So they're not going to be able to step in and grab, very expensive housing, even if mortgage rates stay low for a period of time here, which I expect that they probably will. I don't see any reason for policymakers to want to raise interest rates. So I think rates are probably going to continue in a low period for a while, but that doesn't mean you're going to see a lot of people being able to step up and grab housing at especially elevated values. Now, the wonderful beauty of a free market system, if we would just let it do its job, is that these asset prices come down to a point where corporations and people who have, shrewd investment rules have been out of many of these markets saying, wouldn't touch it with a 10-foot pole. Cash is trash. No, cash is an opportunity that I'll be able to have later. They're sitting there saying, whenever these asset prices come down, I will have a reason to take this cash and put it back to work. And I think that will be the healing mechanism. But as long as governments and policymakers and politicians and everybody keeps trying to stop the healing, stop asset prices from doing what they must, which is to mean revert. And as soon as that process is allowed to take its hold, all that cash will come back into the system, and you will see a lot of people excited about investing, including myself.
Great discussion as always, Danielle. Thanks so much.
Thank you.